Today, we're talking about dividend investing. I've invested over 100 million in dividend paying assets, and I see a lot of mistakes being made from dividend investors. And so today we're going to dive into the weeds on those mistakes, and you're going to come out of this video with a better understanding of dividend investing. You're going to avoid making some of these mistakes, and I think you're going to come out of this video a much better investor. The reason why people love dividend investing so much is because they love the idea of the income coming to fund their lifestyle without having to sell any of the principal of their assets. Nobody loves selling down the principal and watching their balance decline over the years just to buy groceries. So that they're getting right. The concept of your investments generating income for your lifestyle indefinitely, that's spot on. What they miss is that they end up making investments that just have the highest dividend yield because they're like, oh, that must be better, when that can be a trap. They're literally called yield traps because these companies can't sustain often that dividend yield. They're not as profitable as maybe some better companies that are offering a lower initial yield, but they can sustain that yield and grow it over time. And so you can count on it versus some of these companies that aren't very good, cut their dividend or get rid of it altogether. And then it's like pulling the rug out from under you. Yeah, if it was just as easy as looking at a list of stocks and picking the ones with the highest dividends, then we'd all be extremely wealthy, right? We would be all living off our dividends. The key to it is figuring out which of these companies can grow their dividends over time and sustain those levels and make these payouts to you over a very long period of time. We're not trying to get a 6% yield or 3% or 4% in 1 year. We want to do that for 30 plus years. And ideally, we want it to grow and outpace inflation. Well, first, you just want to start with a very good business model. So it has a high return on invested capital. We're talking about companies that have moats. They have a defensive position against the competition, something unique about them that gives them an unfair advantage to generate higher and higher profits each year, right? Because if you have a very good business model, they're likely going to be able to increase pricing each year on their customers without losing a lot of customers. That's called pricing power. And so if you have pricing power, that means usually you can continue to grow your dividend over time. And so we're talking about traditional moats, network effects, regulatory capture. Maybe they have some unique assets that the competition can't replicate. IP, brand even can be a bit of a moat. So these are unique structural advantages that these companies have that enables them to have higher profit margins, which leaves a lot more profit that they can pay out to investors. For example, a unique asset is Texas Pacific Land Trust. They literally have 800,000 acres in the Permian Basin. They own the oil rights and the natural gas rights on that land. And then they lease the land to oil companies who extract the oil and natural gas. And they charge them a toll, like a royalty fee. The most profitable business in the world is getting a royalty on the work and effort of others. And so if you think about it, that is a perfect business model. And they can continue to get higher and higher income each year just by leasing more and more of their land and seeing more oil and more natural gas come out of the ground. And this company, it's TPL is the ticker. People don't think of this as a dividend paying stock because it's less than 1% today. But the key to it is that dividend grows at like 20% a year. So you can compound it over time. It's not going to give you a giant yield up front. But in a portfolio of dividend paying stocks that can grow their profits, you're going to make a lot more money over 10, 20 years with a stock like that than a bad business that might have a higher starting dividend, like 5%, but then cuts it in a few years. And so the nice thing about dividend investing is you don't miss the boat. Right? Is if a company has been paying dividends for a very long time, highly likely that they're going to continue to pay dividends in the future. What you do get the benefit over time is those dividend increases. If you think about it, a dividend stock that's paying 2% a year, if it's growing at say 15% a year, in 5 years, that's going to be a 4% dividend. And then in 5 years after that, it's going to be an 8% dividend. So the going in yield is not as important as the stabilized yield on cost in year 10. In other words, you put $100,000 in a 2% dividend, you hold it for 10 years and it's a grower, that's going to be a $40,000 payment by year 5 and an $80,000 payment in dividends each year by year 10. So it's more about the growth of these dividends over time than it is the initial face rate. There's a couple of benefits to dividend investing that some people just don't really appreciate. And one of them is behavioral. When you are collecting recurring checks from your portfolio each year, when the market has a down year, especially when it has a very down year, you are reluctant to sell. Collecting these recurring checks encourages good behavior, which is staying invested, treating these investments as if you are an owner of the company, and so holding them long term and not panic selling when things are down. right? Because if you just think about stocks as ones and zeros on a screen that are red or green, it's very easy to panic when the market is tanking. But if you think of yourself as a business owner that is benefiting from the cash flow each month, each quarter, year after year from the company, you're going to be really hesitant to give that away. So dividend investing encourages the right investor behavior. Another problem is people investing in 100% REITs, which are real estate investment trusts, which I love. I love the best real estate investment trusts, and we have exposure to a few of them, but they tend to have higher dividend yields because just think about it. They are collecting rent and they get to pay out that rent to their owners. And so some people think, well, if I have just a portfolio of diversified REITs, that's going to have a higher dividend yield. I'm going to make more money each month. The problem is then you are very exposed to the real estate market, and the real estate market is cyclical. It tends to ebb and flow with the capital markets. So it's fine to have a little bit of exposure to REITs, but you don't want your entire portfolio to be exposed to just real estate stocks because of the diversification problem we just talked about. And overall, they're not going to return as much total cash to you over time as a diversified portfolio of different businesses. And then a third mistake I see people make is that they will look at stocks that have been beaten down a lot, right? Because that means their dividend's quite high oftentimes. And so they're looking for some sort of value investment, and they think that dividend's going to be sustainable. First of all, you need to look at the debt balances that these companies have, because oftentimes they are paying out at their dividend in excess of the debt payments that they need to make to their lenders. And so in other words, they're paying out more money than they are earning in profits. That's not sustainable, right? So that's called the payout ratio. And you want to see a payout ratio of ideally 50% or less. Yeah, you can see some that are 70, 80% if it's got a really good predictable business model. What you really don't want to see is the dividend is 120% of whatever they're earning, because that means they're dipping into their cash balances in order to just pay the dividend. Clearly, that's not going to last for long. They can't do that forever. And so all this is not to say that dividend investing is a better strategy than just owning a diversified portfolio of stocks and going for total return, because you can manufacture and create your own dividend, right? You can sell stocks in your retirement and you can take that as profits. It's just that is harder for people to do mentally. And so it's not to say that this is the perfect investment strategy for everybody, but there is a large subset of people that tend to do better just mentally, and they tend to end up owning better companies because they're more profitable companies. So it's a style of investing. If it fits your personality and it hits your goals to achieve a certain amount of income, then it doesn't really matter. Like there's some people who get caught up in trying to beat the market when really you should be trying to solve your income needs or your retirement needs. And whatever strategy does that for you is probably the route you should take. And so where dividends are underhyped or underappreciated, I think, is this viewpoint that it is suboptimal, that they're not going to be able to hit maximum returns. And if you focus on the right things, I think you actually can. I think you can get pretty close to market performance just by focusing on quality companies and dividend growers as opposed to maximum dividend yield. Because the people that are shooting for day one maximum dividend yield, oftentimes they're shooting for 5-6%, which ends up putting them in REITs, as we talked about, oil companies, master limited partnership, which is just pipelines of oil coming through and natural gas, utility companies, which just by default are not going to be high growers. But if you focus on quality companies like, for example, Apple pays a dividend. Apple has been growing their earnings at double digits for a very long time. So you can still be invested in companies that can hit high total returns and are going to grow their dividend over time. And so if you're focused more on a yield in year 10 or really year 20, because we're going to need this income for a long time. So if you can focus on the long term and dividend growth, you can often achieve just as good as market returns, focusing on higher quality companies. Yeah, where this is a good fit for high net worth investors or entrepreneurs who maybe have businesses or used to living off the income from those businesses, this can be an income replacement. And we often find a lot of our entrepreneur clients, they love the idea of taking distributions from their investments, from their productive assets, from their businesses, as opposed to deciding, do I want to sell 3% or 4% this year, right? You don't sell part of your business. You just take the distributions from it. And so that tends to be a good fit, a dividend strategy where it's growing over time. You are living off the income from your portfolio as opposed to selling it down over time. And so I think that is the best way to invest in dividend stocks, is focusing on growers, which means you're going to have lower yields in the beginning. And how we solve for the people that like higher returns day one is we add alternative assets that tend to pay higher incomes day one. And then we also invest in the dividend growth stocks. So we let the dividend growers happen in the background, compounding, reinvesting dividends. And so that yield on cost 10 years from now is a much higher dividend payout, whereas we're benefiting from the income from the private investments, real estate debt, real asset investments day one at higher yields. And that's a great way. It's a nice compromise for people because they're getting high income day one from those private investments and they have their dividend growth for the future. And so if you're a high net worth investor that could benefit from an evergreen income strategy that we've just laid out here on this video, go ahead and reach out below. There's resources for you. Thanks for watching.